Okay, everyone, welcome to Macro Race with your host, Tony. We've got about a minute left until we start, but hopefully you guys can all see the screen clearly and also hear me clearly as well. All right, okay, so let's go through the EI inventories data. Uh, Talhalala said there is no oil inventory data today. Yes, there is. We've got the other calendars also showing that the EI inventories data is coming out today. I think you might be thinking about the oil monthly report from the EIA that was due to come out last week, but did come out yesterday, excuse me, for oil. Actually, the day before that, on Tuesday, for oil inventories. But this is the EI inventories data that we will be getting today. So if you were thinking that it's not going to have, there isn't going to be any today, there is. So what I want to do, as I usually do, is run you through what to expect for the economic release, what it is, how it affects the markets, and also what is the current sentiment that is surrounding the oil market at the moment as well, before we get the data today. So let's run it through here then. So the key thing is as to what is it then. So it represents a weekly change in crude, gas, and distillate inventories, and transportation is affected the most. Of course, businesses transporting those goods. It also affects consumer prices for a number of products. So think about in your home or in your office, a lot of products are made from refined crude oil, and that can also create issues when, of course, there is a higher demand for oil. Then that causes higher prices for those goods when they're created. Of course, you've got to think about factories, the manufacturing sector, the industrial area too, that use or rely heavily on a refined oil to be able to make those, to be able to find those raw materials. And then there's businesses to be able to make them into intermediate goods. And then finally, and then into the final stage where they're turned into the final product or the finished goods. That's what we need to be aware of. So consumer prices can be affected and have been affected by the rise in crude oil prices that we've seen, and also in general other areas too, with natural gas prices as well. So if we look at as to why it's a release to watch, so before the Ukraine-Russia conflict, we had seen that the oil releases were quite volatile, where you could get up to a $2 move. But recently we've been getting, I think, the highest amount that we've seen, or the biggest move that we've seen on the initial candle is $1.32. But now it's more so muted. We can probably get about 40 ticks or so, around 30 ticks on the crude oil inventories data, but it is still a release to watch, as you can get a lot of whipsawing of volatility on the first candle, and then the market kind of subsides and carries on its movement. So other than why it's volatile, so how does it affect the markets? If you're not familiar with the crude oil inventories data or the EI inventories data as a whole, the key thing to remember is that when more oil is added, that it is negative for oil prices. Of course, if there's more oil that's added, but there isn't that much of a demand for it to match it, or if there's a surplus of it, then that will cause oil prices to go down in the short term off the back of the EI inventories data reaction. And on the flip side, when we're talking about when there's less oil added, but there's a high demand for it, then oil prices start to head, WTI crude oil prices start to head higher. But of course, if there's more demand, but it's less available, then that pushes up prices. So think of it in the way with consumer price index or the CPI report in any nation. If there are the same amount of goods, but people have more money to spend on those goods, the price of those goods are going to start they're going to start to rise further. So then businesses aren't completely depleted of all the goods that they have. So that's the key thing to remember: the short-term reaction as well, and the long-term reaction. When more oil is added, it's negative for oil. When there's a build, or when there's less oil added, when there's a draw, it's positive for oil prices. Then the triggers then, when we're looking at what to kind of expect. So you have economists who are looking at a high estimate of 3.1 million with a low estimate of -4 million. Now, bearing in mind the median forecast from economists' point of view for EI crude oil inventories is -1.55 million with a prior of -2.762 million. And then the gasoline are looking for economists are looking for a high estimate of 1.5 million with a low of -3.5 million. And if we're looking at the median forecast is for a draw or to a -1.05 million compared to the prior of 2.645 million. And then distillate inventories, so they're looking for a high of 2.3 million with a low of -0.5 million. So these are the actual figures that they're looking for to meet the high and low end. And then the forecast for distillate inventories is 1 million with a prior at 2.559 million. So overall, with the gasoline and distillate, we're expecting a drawdown in inventories, but with the crude oil inventories data, we're expecting a slight, economists are expecting about a 1 million build or 1.2 million build in the crude oil inventories data itself. And then the other key thing that everyone needs to be aware of, or if you're not aware of, which you should be aware of, is the API data. So the American Petroleum Institute releases their own figures of, whether there were more oil barrels being added to storage or if there was oil barrels being drawn or taken out and being used. That's quite important data because one, it's released the night before. Two, of course, these are the big businesses within America that show, what their inventories are like. And thirdly, it has also been released that traders have traded in the past as well because it has caused a lot of volatility. And then the fourth reason is that sometimes, and not always, you can see a correlation between the API data and the official government data that is released the following day. So what do I mean by that? So if the API data overall shows a build in data or build in inventories, sometimes, but not all the times, the EI inventories data could show the same direction. And could actually show that there was also a build in the government data that was released the following day as well. So as said, there's not always a very strong correlation, but sometimes traders try to price in what could occur to the markets when we do get the EI inventories data. But like I said, that's not that there isn't a strong correlation. So of course, you still need to look at the official data and make your own assessment and judgment as to how the market is going to react, or whether there's going to be a strong reaction from the market if it hasn't reacted to the private data the night before. Now, the other thing to consider then when we're looking at the API data, so we had API distillate stock change, which had shown a draw compared to the prior at -0.635 million. And then if we carry on, so API gasoline stock change had shown a draw as well at -1.814 million. And then crude oil inventories had shown a build instead, had shown a build of 3.825 million compared to the forecast of minus 1.1 million. So the forecast was for a build anyway, but we had seen a much larger build compared to the forecast figure. So if we're, of course, bearing in mind what the forecast figures for today, it is more or less, they're looking to go in the same direction. As you can see, they're expecting crude to show a build, gasoline and distillate to show a draw. So could the data from API could it show a similar the same direction for all these bits of data that we get to today from the EI? That's a possibility, but doesn't mean that it's always going to happen. But again, as I said, it is something that traders do keep in the back of their mind and try and gauge as to where the EI, the actual figure, could be the following day. So enough with the triggers then. If we're looking at what's driving sentiment at the moment, so this is quite key, and as to why we've seen WTI crude oil now up 6% on the day so far. One of the key reasons, or one of the general reasons as to why, if we're looking at the reasons why oil is going up so much, is there's the 3 R's. So on the downside for crude oil, one of the headlines is that Iran could plans to boost production to 570,000 barrels per day from 190,000 barrels per day within 7 years. That's one headline for the downside. And then we have the 3 R's, okay? And we're going to JP Morgan because they're going into a bit more detail about those 3 R's. But you have the recession, where traders are fearing that if a recession occurs, there's going to be a loss of demand for crude oil. And because of the increase in oil production that OPEC has done as well, and that is where we're going to see a surplus. We're actually going to see that oil prices will start to move further down as there's less demand. How we've seen that through the COVID pandemic with China, that's been very evident, is that when the country drops, when a country's productivity drops off, manufacturing sectors start to wind down and they're not producing as much, then price of oil starts to head lower as well within the recessionary phase. If you've watched my video that I did on the weekend about trading economic releases and understanding the business cycle, that's quite a key thing too, is that during a recession, you usually see bond yields decline, you see oil, you also see commodities also see a decline as well, and then those other cyclical stocks, they also see a decline as well. So that's one thing the markets are keeping an eye on in the back of their mind, that the recession fears are hitting the markets, or have been. But recently, the reason why we're seeing an uptick in crude oil is because of the potential, first of all, the potential cap on Russian oil prices from Europe, and Russia taking retaliatory action, or potential retaliatory action, against the European Union to, as a tit for tat sort of thing. So Russian oil exports is a key factor at the moment. You've got one of the headlines one of the key things that you've had from today is that Russia halted a key Kazakh export terminal, or the CPC, that had been expected to load about 1.24 million barrels a day in July, and that was according to some of the plans. But the Russians halting or cutting off some of their oil flow to the European Union has had a positive impact on oil prices, as of course we know there is a huge demand for oil at the moment, and there isn't being enough produced because there isn't enough investment going into those refineries or to set up other refineries. So from that's helped push up oil prices even further. So that's one thing we've got to understand, is that there's a curtailment of Russian oil supply that's having an effect and could have a further bigger effect if there's a complete cutoff of Russian energy to the European Union and also other nations as well that rely on Russian energy, such as China to a degree, and India as well. And then we have regulatory issues too. So there's issues of when you're setting up new refineries, make sure that they meet those regulatory requirements. That's pushing back timelines for getting that supply up and running and refining that crude or still or gasoline product out to the market for businesses to use. Then as said, so you had a Russian court ruling. This was yesterday that they said that they were going to a Russian court ruling to block oil loadings from a Black Sea port had alarmed European crude traders who are already dealing with the tightest regional market in years, which again, as said, has been driving up prices for competing barrels soaring. So on top of that, you've had this the further fears that Russia could take bigger action to curtail the amount of oil that is provided to the European Union. Then if we're looking at bank visas and what they see as well. So this has been quite choppy in regards to where WTI crude oil prices are headed and where they could head or where they are at the moment. You've had a variety and a mixture of different thoughts. So Goldman Sachs, Citi, and JP Morgan have come out with very stark differences in their thoughts for where WTI crude oil prices could be. So if we're looking at Goldman Sachs. So they see, well, this is back on June 22nd. If I work my way backwards to make it easy for you to understand. So Goldman Sachs, back on June 22nd, they said that policy risks, i.e. tighter monetary policy from central banks, could bring down WTI crude oil, could bring down crude oil to $140 a barrel in their 3-month crude forecast. Then we have JP Morgan. They actually see that in a stratospheric, they also see a stratospheric $380 on a worst case Russian cut of energy if the US and EU impose penalties on Russia. And then Citi kept saying that in the event of a recession, oil could fall to $65 a barrel by the end of the year and possibly to $45 a barrel by the end of 2023. So how do you kind of read into that data? How do you digest it? What does it mean for us as traders? So they're focusing on different things here. One, you have JP Morgan focusing on central banks and tighter monetary policy having an effect on economies that could leave those countries going into recessions, and in turn will lead to a drop in demand for crude oil. So that's one thing we've got to bear in mind. Second of all, you've got JP Morgan talking about the potential for cutoff of Russian energy that will send oil prices and natural gas prices soaring in the market. So you have two things that you have to be aware of that are affecting sentiment at the moment, which is why it's quite difficult. One day you might have oil going up because of the potential of a Russian cut in energy. But on the other day, you could have policymakers or investment banks citing recessionary fears creeping in that could dampen oil prices and you could have a bearish day in crude oil off of the back of that. So that's what we've got to be aware of, is that there's a mixture of this different sentiment that is having an effect in the oil markets. But the other thing, when we're talking about regulatory areas too and getting those refineries up, so you had on July 7th, or today, you had JP Morgan saying that while structural underinvestment constrains supply, demand remains resilient in the face of recessionary fears. So if you're talking about how bad a recession is going to affect demand, JP Morgan saying that because there's such a strong demand for oil at the moment, that's going to last. That's probably going to last a bit longer if the US does go into, or if the global economy does go into a recession overall. Let's see. But yes, so that is the bank fees and what they see at the moment. Okay, so let's have a look at the prior release we had. So we're going from about 7 seconds before the release. I want to show you. So this is the delayed data that we should have got out. Should have got a couple of weeks ago, but then they also included the data for the week before last week. Excuse me. They also included the data for last week as well. So the key thing is that there wasn't really a market reaction to the data. One, because it was combined with some of the old data from what should have been on 17th of June, or what should have been released the following week, with the new data as well. But there wasn't that much of a deviation on the forecast or on the headline, on the figures that had come out. On top of that, you didn't see, as I said, you didn't see too much reaction from the markets. If I play the video, so I said about 6 seconds. Okay, so the data came out showing a draw there. Overall, the rest of the EIA data has shown a build in inventories data. But here, see, you didn't see too much reaction there from the market. Okay, so if we carry on then, so that's basically the release. That's basically what we're expecting there. So if we look at the deviations then, we had seen beforehand. So here we are. So as said, there was about 1.81 million deviation on the headline figure. And the other two bits of data has shown an overall build. But as said, the data was mixed with old data, so we didn't see too much a reaction there from the markets. We'd seen about 21 ticks was the upside and about 61 ticks was the downside, about 10 minutes after the release of that data there. So again, didn't see much reaction from that data. Other than that, so generally one thing to expect is, I think now that we're not combining data for this week, what we're expecting is we're expecting to see a bit more of a reaction, hopefully, in the markets. So overall, usually we'd expect we had our headline figure with a deviation of 5 million compared to the forecast figure compared to the actual figure, or the difference between those figures there. So looking for about for the actual figure to be at 6.55 million on the headline figure, and then you look for the other two bits of data to show to see a movement in the same direction. If you're looking for crude oil inventories data to show a draw, you'd want 5 million deviation on the headline figure, and for a build you'd want the same thing too, for 5 million deviation on the headline figure as well. But the key thing is you'd want the other two bits of data to follow in the same direction to get a stronger reaction. If we do get a mix of data from the report that comes out, then you'd want to instead, you may expect some more of a choppy reaction in the markets, and you may not. That what could happen instead is that you may see a blip, a reaction where you do get a little bit of reaction, a pop, either up or down, and then it doesn't last that long, and it kind of and then we kind of carry on with the current market movements that we see. But that basically sums that up there for us. And if we can buy tick strike open up. All right, so we've got about 3 minutes left. Hey, Galaxy One, good to see you. Yes, I am still here. I've gone through the EI inventories data now. The prep it wasn't too. There wasn't a lot to kind of go through. It was more simple this time round. So we've got about 3 minutes left till the release. So as said, if we're looking at what oil is at the moment, we know we've got. So we can see that it's already up on the day about 5.7%, but we have seen that big move towards the upside at NYMEX Open at 9 o'clock in the morning Eastern Time. All right, so about 1 minute left now till we get the data. We give my tick strike running here. So tick strike is used to gauge order flow and the amount of momentum that there is. We do have a 7-day free trial of that. If you have tried to use tick strike before, or if you haven't traded with tick strike, and then we have the 7-day free trial for you here to use. That's there for you. But yes, we've got about 25 seconds to use left. 20 seconds. Okay, not too long left. 8.235 million, 8.235 million. That's a build on the forecast of minus 1.55 million. Gasoline inventories at minus 2.496 million, minus 2.496 million. That's a draw on the forecast of minus 1.05 million. EI distillate inventories minus 1.266 million, minus 1.266 million. That's a draw on the forecast of 1 million. So it's seeing some movement towards the downside there on crude. What we can see, let's kind of have a little. Let's kind of wait for that first candle to finish. See what we get. Okay, so whilst we're waiting for that first candle to kind of finish its move, overall, we're looking at the deviations then. If I just bring that up. Okay. Well, let me sort this out. Okay, so we'll look. Okay, so there was, for the headline figure, there was a 9 million deviation for the headline figure. And if we're looking at the gasoline, so forecast was minus 1.05 million. Distillate. Okay, so gasoline had a 1.4 million deviation, and distillates about a 2.3 million deviation. So that's about 4 million of a deviation there on the draw side for gasoline distillate, and then crude oil has seen a 9 million deviation. Okay, so that's that 1 minute candle done. So let's have a quick measure of it. See what we got. Okay, so there's about 65 ticks towards the downside there on WTI crude oil. So it was a stronger reaction compared to what we had seen last time round, where we had seen minimal reaction from the data. And then other than that, I think the key thing to remember is, of course, so as I was saying with tick strike, so you can currently seeing it go off at the moment. So if you're, if you're wanting to manage your trade, your risk, or capitalize potential trades, if you're a scalper, then tick strike could be something that is something that could be quite useful to you. Of course, you can trade with it however you want to, but as I said, it measures and it shows you, gives you alerts as to how much momentum of buying or selling that there is within that certain asset class or certain asset that you're looking at. So that's what tick strike is quite useful for. I've put in the link for tick strike for 7-day free trial, and you can go to the link and have a little go with it. Also, with Financials Pro, where the data had appeared, you hopefully would have seen that the data would have come out, and then you will see the market reaction. So, of course, with a live voice and text service or real-time squawk service, you can, it's something that investment banks use, and it's quite high level as well for those investment banks to manage their risk and also capitalize on potential trades. So you can do that there as well on the Financials website, and we'll provide you a 7-day free trial of that as well. Let's pop that in here for you. 7-day free trial there. Financial use Pro. Now, the key thing between Pro and the Lite version, in the Pro version, you don't get any adverts playing. You also don't get any delay to the website as well. So you can have a go and mess around with how, if you're new to what a Squawk service is or live voice and text feed is, then you can have a little play around and try and learn how to kind of manage your risk or capitalize on potential trades or use it however you want to use it. There isn't a one right way. Of course, everyone has their own trading strategies and how they use their own bits to try and help that there. But yes, so that link I've put in the chat as well. You can also, if you did like the content, if you like the content that I put out today as well, you can follow us on Twitter at MacroAce. That's also available for you there. And we also have a new product that we're beta testing at the moment, which is unusual activity. So if you like to trade unusual volume activity in stocks, then you can join the free beta test group of our new service. And that's, here we go. That's that there. That's the link there as well. So don't forget to have a little look at that too. Also with the, of course, tomorrow we have non-farm payrolls. So let me pop that link in for you here into the chat so you can join me live for it as well. But other than that, ladies and gentlemen, thank you very much and take care. Thank you, Galaxy One. Have a nice day too.